investing is an exciting and rewarding way of investing in startups. Imagine being a foundation investor in a technology company that delivers a cure for diabetes. That's a real Australian case right now. Imagine as a shareholder, your advice helps a company succeed with a universal payment system that has all the convenience and security of credit cards and none of the fees. That's an actual angel-backed Australian venture. Imagine you invested in a startup just as it started to generate revenue, and 6 years later, it sold to a global corporate, giving you 10 times your money back. Imagine the fun and satisfaction of mastering the skills of angel investing, then sharing those skills with aspiring angels and as an advisor to startup founders. Angel investing means being a proactive participant in this adventure for a whole bunch of startups. No one has a perfect model to startup success. It is not all about the money, and this should not be your primary wealth generation activity. So why? Why do we need startups? Why invest in startups? Why take the extreme risks? Everyone is looking to radical innovation to lead us out of our troubles and into a better world. Startups are designed to succeed at radical innovation. To offset the risk and high failure rate of startups, you'll need to build a portfolio of at least 10 concurrent investments. A portfolio is important because startup investments are illiquid. You can reasonably expect that at least half of everything you invest in as an angel investor will completely fail to return any cash to you at all. This is all about high risk and high reward. But what rewards should you expect from angel investing? The rewards are certainly financial. However, all the most successful angel investors I know around the world are more focused on other metrics of success. The personal satisfaction of making a contribution to the growth and improvement of our society. Paying it forward by creating new, well-paid jobs within our own community. Plus, there's actually a lot of fun to be had as an angel investor. From the camaraderie of a diverse group of good people with shared values doing good things together, to the simple joy of using what we know to help others create new value. The intellectual challenge of seeing the world differently through the eyes of a visionary founder. The satisfaction of disrupting the status quo to change the world for the better. And the appreciation from the founders for your valued involvement. Still, what about the money? Well, my first angel investment was last century and it delivered a 100 times return. That is, when I sold my shares about 4 years after investing, I received 100 times more money than I invested. My first angel investment this century returned 34 times after 10 years. By comparison, in the noughties, I co-founded one of the best performing VC funds in Australia, and that returned 8 times in 5 years. So every company in which you invest must be exposed to the risk of success. Our job as angels is not to find the reasons why a venture might fail. Any 12-year-old kid can say it will fail and likely be right, since in excess of 75% of all new ventures fail, even more with startups. No, the real art is to see the opportunity for success and a credible path to exit. So who can do this? Who can be an angel investor? Anyone. Anyone with the passion, the time, and a modest financial capacity. Angel investing is for women and for men, young and old. Some will have deep expertise, others extensive experience. Some will bring a fresh perspective, and others a youthful positivity. Many are still working full-time, some have sold their businesses, and others have retired from their primary careers. Most angels are people who have built or are building their own success, which gives them the confidence to guide others. You don't have to wait. Some of the most valuable insights for the best investment decisions come from those angels who are embedded in the relevant markets or customer experiences. You should develop your own angel investment thesis. That's the model of money, timing, sector, opportunity, and engagement that you believe will deliver the best chances of success for you. These are not immutable limits. They provide a guide for good investment discipline. When you join an angel group, At least some of those parameters will be set by the group focus and the group process. So how do you actually do the angel investing? Well, your thesis will help you know what you want. Then you will need a process, a way to source deals in what is a very noisy marketplace. Quickly filter and evaluate those opportunities for a good fit, know what you consider reasonable terms for investment, and have a way to stay engaged. Rule of thumb, you need to touch 50 to 100 initial opportunities to find one that is a right fit for you. The research shows that doing a good job of due diligence before investing and of engagement after investing have the biggest impact on the success of your investments. Now, founders are always eager to move quickly, but beware. Speed is not always your friend when you're trying to validate the opportunity and working to establish a relationship that is likely to last at least 5 years, even longer if it's a huge success. Remember the old saying, act in haste, repent at leisure. On the other hand, taking too long can be just as bad. So can we do this in Australia? Absolutely. A great example from the Melbourne Angels portfolio is Rometorio. This company was founded by two very clever young men committed to the idea that they could build in Melbourne a world-leading tech company that would dominate a global market. They did exactly that, defining and dominating the global market segment for multimodal travel planning. And they did it with just 2 early rounds of modest angel investment and a strong focus on over-delivering on their value proposition to their customers. The result is that last November, after 6 years, the company was sold to a German online travel conglomerate for a very satisfying return to the investors, and of course, an even more satisfying return to the founders. But it's better than that. Rometorio will continue to operate in Melbourne under its own brand, growing its core business, employing more people, paying local taxes, and enhancing the reputation of Australia. The Melbourne Angels member, who was a director and had served as chairman of Rometorio, was encouraged by the acquirer to remain on the board, which she has done. This is what we want to see. Companies that do something entirely new, open new markets, create new jobs, and drive significant export revenues, all from an Australian base, with the support of angel investment of money and advice. So why join an angel group? Well, to build a portfolio on your own is expensive in dollars, time, and the opportunity cost against all the other things you want to do in your life. An angel group offers you 3 things that lie at the core of realizing an effective, successful, and enjoyable portfolio of startup investments. When you join a group, you get access to the deeper financial resources of the collective, and thus you are able to invest a little bit less per deal in more deals than you would be likely to do on your own. This diversification by volume is the first primary risk mitigation strategy of any investment portfolio. Most people are astute enough to know they want to invest in things they understand. No matter how experienced we are or how much we know, each of us is only likely to be deeply confident in a relatively narrow range of business endeavors. On our own, we are challenged to find all the best opportunities within that narrow scope. When you join an angel group, you benefit from the depth, breadth, and diversity of the expertise, experience, and networks of all the other members. You are able to invest in a greater range of businesses than you are likely to have done on your own. This diversification by scope is the second primary risk mitigation strategy of any investment portfolio. Now, in theory, you could do both those things on your own. That is, you could make more money and you could learn new stuff. In practice, it may not be that easy. The third benefit of a group is time. The whole process of sourcing and evaluating opportunities, negotiating investments, coaching founders, and supporting exits demands a wide range of skills and a lot of time. Remember that 100-to-1 ratio? And that's just the sourcing step. When you join an angel group, you get to learn and refine your skills through practice and training with experienced colleagues. When you join a member-led angel group, you benefit from the time of all the other members. The collective, collaborative effort of the group is what gives you the time to learn, the capacity to process the volume of opportunities, and, perhaps most importantly, a chance to enjoy it all, to have some fun. Melbourne Angels has invested in more than 75 companies and over 100 rounds of investment. Typically, we invest in pre-revenue ventures at a key value inflection point. That's usually revenue, but it depends on the sector and the business model. For portfolio companies that are succeeding, it is not uncommon that we support them through 4 or 5 rounds of investment. Successful companies in our portfolio are currently valued at 10, 20, and 30 times our original investment value. Our exits have included trade sales like Rometorio, ASX listings, script-based mergers, debt redemptions, and of course, some simple shutdowns. But how much money do you need to be a member of an angel group? Well, we recommend that you should be able and willing to invest at least 1 or 2 investments per year for 5 years to develop that concurrent portfolio of 10 investments. You may move faster. Groups like Melbourne Angels welcome you investing in smaller amounts if you are an active contributor whose experience and expertise help all of us to make better investment decisions. While at Melbourne Angels, we are sector agnostic. We have learned over time there are some investments our members simply don't want to consider, like gambling. But the thing about sectors in early stage investing is not to follow trends. Trends are backward-looking phenomena. As early stage startup investors, we must anticipate the market, not follow it. Companies typically take at least 2 to 3 years to be ready to meet the market. And in fact, market timing is the number one reason for both success and failure. Investing in startups, the people are both the most important and the hardest piece of the puzzle. The diverse experiences and skills of an angel group are invaluable in effectively and efficiently evaluating the founders and their teams. Angel investing is focused on aligning our interests with those of the founders towards an alignment of shared future success. The angel group process and legal documents are all designed to achieve that alignment. Usually in an angel group, you decide which investments you'll make and how much to invest. The collaborative process ensures all the angels share the due diligence, invest on the same terms, and contribute to supporting the portfolio companies. In a member-led group, the members do the work of organising our events and running the group. At Melbourne Angels, opportunities are screened continuously throughout the year, and we meet twice a month to receive pitches, typically completing 20 investments every year. Our members are active in the startup community as founders, business leaders, mentors, advisors, and much more. At Melbourne Angels, our training workshops are designed for Australia, created and delivered by internationally respected angel investors. These workshops are free to our members, open to other startup investors, and to anyone who's interested to learn the art and skills of investing in startups. It's not uncommon that more than a third of the participants in our workshops are startup founders. At Melbourne Angels, you will find a professional, collegiate, and ethical community of like-minded peers. Joining an angel group can't guarantee you'll make a great investment, but it can certainly help you avoid making the bad ones. It will most definitely allow you to enjoy the fun and adventure of investing in startups. So if you want to be an angel, ask us whatever you want to know. You've just been listening to me, and wait, this way. I've got Paul Barron and Tracy Cooper, also from Melbourne Angels. So we'd welcome your questions. But while we're waiting for you to bring in some questions, Tracy, perhaps you'd like to share a little bit about your experience as an angel investor.
Thank you, Jordan. I've been lucky to have some fabulous experiences as an angel investor from the perspective of a successful exit of Rometorio, which has been a wonderful journey, and seeing 2 young, super smart guys prevail in the travel sector. And you can imagine exiting a business in the travel sector just before COVID hit as a sweeter delight to it than you can possibly imagine. I've also been lucky enough to be involved in things where the business did not go so well, and the Angels had to step in to help right the organisation and make sure that governance was better on board. So from a negative, we're hoping to create more positives. So it's always interesting. It's always intellectually hard, and it's always about mentoring, coaching, and developing founders and the business to get better and keep a laser-like focus on what they want to do in terms of exit.
Thanks very much, Tracy. Paul, why don't you give us a quick view of what your experience has been?
Sure. Thank you, Jordan. Look, I've been an angel investor for a couple of years now. And for me, it's been a wonderful journey. Look, I had a startup in the mid-90s as a founder, which didn't work out. And then a life in the corporate and government world. And then I guess I had the opportunity a couple of years ago to make a change, and I'd been itching to get back into the startup world. But this time I realised it wasn't the time of life for me to be a founder anymore, and I was more interested in contributing to the success of others and going on the journey with them. So as an angel investor, and particularly with quite a number of the investments I've made, I'm very much on the journey with the startup founder, supporting them and being a part of that journey, which is a lot of fun. The group approach is fantastic too. Look, I've learned so much over the last couple of years being an angel investor off not only my colleagues, but also through the startup founders. So that's great fun, and it's wonderful to be part of the startup community here in Melbourne, but also in Australia. We're quite connected as angel groups around Australia, and I know later in the week people like Simon Horn are talking about Angel Loop, and if you've been sort of listening today, there's Sydney Angels, there's Brisbane Angels. We're a really great startup community here in Australia, and it's wonderful to be part of that.
Thanks. So we have a question, and maybe Tracy, you'd like to have a go at answering the question. Question is, do we as angels invest in franchise type business models? How would you look at a franchise opportunity?
That's an interesting question. If the business model is a franchise opportunity, so in other words, there's an IP, there's a business that someone feels they can grow by actually developing a franchise of their own to take to market, that would be something that a Melbourne Angel, I as an angel would be interested in looking at. It's a go-to-market or a growth model. If it was looking at investing in a franchise from offshore or from a local franchise, then that's not necessarily an angel model. That's really someone who wants to take an existing business model and invest in it. So that wouldn't be something that would necessarily excite too many angels. And the reason for that is that actually the business model, once you've actually got someone who's able to sell you a franchise, the business model is there. It's just a matter of having some working capital to kick it off, which is totally different to what angels do, which is help businesses that take infancy models and infancy business ideas where there might be about to be some revenue, and help them continue to hone that and grow that and look at ways that they can actually create their own wealth into the future. I hope that answers that, Jordan.
I think that sounds great. So the emphasis on that point is, as angels, we're investing for significant capital value growth rather than a sustained dividend stream. And I think that's perhaps part of the difference between a master franchise or a franchisee model. So PJ, I hope that answered your question. Paul, you could ask her a question for Mark. Mark wants to know, do you have to be rich to be an angel? We talked about investing 2 or more times a year, but how much money would that represent?
Look, I'm probably a relatively poor angel in that kind of way. You need to have the capacity to lose money and not get too distressed about that. So, look, the formal recommendation tends to be not to invest more than, say, 15% of your investment portfolio, if you like, in angel investment. I do more than that, I guess, because I'm passionate about creating new things. So for me, look, if you can afford to make a couple of investments of, say, $25,000 a year over, a few years, then that's fine. So you sort of need to have that capacity. But again, I think, as Jordan mentioned in the video, often we've got younger members who are earlier in their career as part of Melbourne Angels that might put in sort of smaller investments, $10,000 to $15,000, say, on an investment, because they want to learn, and they want to be a part of things. But you do sort of need to have that capacity and not to get too distressed if, half the checks you write, you'll never probably see the money again. So you've got to be either prepared for that or able to cope with that financially. Jordan, is that a reasonable answer? You're probably more a tighter view than me. I'm going to be pretty flexible.
I think that's the right answer. You can't really get involved in angel investing with a reasonable expectation of success if you're not able to build a reasonable sized portfolio. And the experience around the world tends to suggest that a minimum of 10 concurrent investments is what has the best minimum chance of getting you there. And to make those investments, particularly in an angel group context, you usually have to have the kind of money that Paul's been talking about. Obviously, there are those who invest a lot more, but that's at the sort of the lower end. Now, in a similar question, though, related more to the activity, Peter's asked about how much involvement we have as angel investors in the startups, and for an angel investor who is heavily involved, what does that look like? So I think we've each got a perspective. So perhaps I'll just start by saying that one of the benefits of the group is you can share that time. That's what I was saying in the video, that I don't have to get deeply involved in every company that I invest in, because other members of the group be the ones who take the point on those deals. So that's one aspect of it. The other aspect is that the demand or the opportunity to be deeply influential in a company will vary over time. So when you are an angel investor and you have a larger portfolio, it's not that you necessarily are spending a day a week on every single company, which would limit you to only having 5 to 7 companies. It's more a case of there are things you can do to help the companies, and sometimes that'll take a lot of your time over a short period of time. And then other times when they're going to be running well and there's less that you can offer right now, when you'll be focusing on another company in the portfolio. So that's sort of from the my personal portfolio is a little bit over 40 companies, so that's looking at it from the larger perspective. But Tracy, as she said, has had a much deeper engagement in frontline roles as a non-executive director for a number of our companies. So Tracy, why don't you talk about what that looks like?
Yeah, thanks, Jordan. I still think it's exactly the same. If you can add some value and you're required to add some value, then as an angel, that's sort of really your reason for being. But also remember that you're not trying to buy yourself a job or a place in a business. What you're trying to do is provide some capital, maybe representation of the investors, and then some smarts to help founders grow and develop their business. And so whenever you're involved because there's a requirement for you to help. There's a way that you can help. And the Rometorio one's a great example. Over 6 years, whilst I was on the board for that entire time, there were many times where it was really just a governance thing. We would meet to make sure we could sign off the financials. The business was ticking along. And then they would hit a bump, or we would look at a strategic direction, or we would try and figure out how to grow or scale the team. And at that point in time, becoming a little bit more involved to help guide the founders. But it was their business, not my business. I was a mentor to them. And I think it's a really important nuance. As an angel, you don't want to impose yourself or your ideas. You want to tease out their ideas and try and help them understand what is good and what could get better. and that's it's a nuance that I think is really important for people to understand.
Thanks. And Paul, maybe you'd comment from some of your experience, particularly in terms of doing the deals.
Well, it's interesting. Certainly, and look, I guess some of you might know that as you go through the process of deciding if you're going to invest in a company as a group, you've got a process you go through. And some of those processes, particularly near the end, are about, I've led the deal, for instance, for a couple of our portfolio companies. You get quite close to the founders and you're on the journey with them and trying to help them raise capital. But there's many aspects to things. I'll give you an example. So I'm a non-executive director. I was elected by the shareholders of one of our portfolio companies. I came in the first round and became, like Tracy was, elected by the Melbourne Angels onto the board. When it came time to raise again, I then led the deal through back into Melbourne Angels. And leading a deal was quite time-consuming, but very rewarding. But basically, if you've got an angel leading the deal for you back into other angels, it tends to be a much more satisfactory outcome. It's faster. I know what the other investors want to hear and want to know, and we can guide them through that process to get a satisfactory outcome. Jordan, is that the kind of answer you're after there?
I hope that's an answer that helps Peter. Mark's asked us another question. Mark's asked us about the tax implications of a loss or of an exit. So, Mark, I guess the answer there is, as always, it depends on your own personal situation. At Melbourne Angels, we typically invest directly in the company, which means as an individual, we do get access to losses. That is, we can use them for tax purposes. The main way that you would use a loss is to offset it against another gain in your personal affairs. So the use of a loss is a capital offset against a capital gain. And of course, you can carry those forward. So that's really all I can say about a loss at the moment. In terms of an exit, again, it depends on your personal circumstances and how you've invested. I invest as an individual. So I have access to rollover relief on the capital gains, which means that if I've made a capital gain, the taxable portion of that gain, which is only 50%, I can actually postpone paying the tax on that if I've made a similar investment with that money in the next 2 years, or in fact, even in the year before I receive the return. So those are some of the quirks of tax stuff. One of the important things is these days we have a national tax incentive for early stage investing. And under that incentive, if you opt to register for that incentive on a particular investment, you lose access to the losses, but you get complete capital gains relief on any returns. So it comes down, as always with tax stuff, to understanding what your own position is, what the circumstances and the regulations are, and then the result of the actual outcomes when they happen. So there's the other thing I'd like to perhaps ask my colleagues to talk about is a little bit about what it's like to be in an angel group. So Tracy, you joined about 8 years ago, if I remember correctly, and you've had a number of different roles. When you joined, you and your husband joined together as a very active team. You took the front foot, got very involved. Then as things changed, you flipped that and Frank got more involved. But why don't you express how that can happen and what people can think about as their involvement?
Yeah, I think that you can choose to be as involved as you want to be, and it's always about where your life stage is, your own career, what you've got else going on in your life, I suppose. But the whole point about being in an angel group is that you have a diverse set of views that come together to look at a problem or to look at an opportunity. And so I find that it's a really respectful space. It's a great place where when someone's doing a pitch and you can see that people are asking questions from a totally different perspective than where you would ask a question from. And over a period of time, you become really reliant as a group on those individuals, because all of a sudden you go, actually, I've got an idea that I think this business would be a great business, but I'm going to go and speak to my colleague, Jeff, because Jeff always thinks very different to me, and he's going to be the one that's going to help me tease out whether this is something I should introduce to the Angels, for example. So I found it to be a really, really great way of getting a team of people together with diverse views, but always, focusing on quite a positive outcome. The other thing is also people come and go from the group, and that's a good thing, because people's contribution then never gets stale, and I think that's really important. And finally, people engage in different ways, and the way that we at Melbourne Angels work is, for example, before COVID, we had a regular monthly lunch, and I'm not a luncher. I just don't really like going to lunch, so I really never went to any of them. But they are really popular for some people who love going to lunch and networking. So what you find is that as a group, you all figure out how you want to engage, and then it sort of works really well. But I mean, Paul, you're sort of a couple of years in, where I feel like an old dinosaur. I was going to say I was the youthful positivity, by the way. Now I'm like 8 years in. I can't be that, can I? So I might hand over to you.
Yes, well, I mean, look, one of the things the great thing when you join an angel group is you think you know stuff, and then you realise you don't. I mean, certainly in Melbourne Angels, and I know other angel groups are the same, the training's fantastic. So you learn about cap tables, term sheets, shareholder agreements, all of those sort of things. But more than that, when you can be as involved in a deal as you like, but it's often when you're involved, you learn by doing. And it's like having, I was going to say security blankets is the wrong term, more like, anyway, as a safety belts, things like that. As you go through the deal process, you've got really experienced people around you, sort of saving you from making obvious errors, or at least. So I've found the last couple of years to be a little bit like doing an MBA, very hands-on. And that's because I very much like to be involved in the process. You don't have to, by the way. You can just sit back and just invest at different times based on what you see and what you hear. There's a place for everyone and every different type of person in the group. But for me, anyway, I've learned so much, and I continue to learn. And it's been fantastic part of being in the group.
Thanks, Paul. So I guess what I'd like to make clear to people is, if you're thinking about being an angel investor, there are lots of different ways to do it. Broadly speaking, angel groups have been seen as best practice, because like in any other activity, you're much more likely to succeed working in a team than flying solo. That's not to say that you can't do it flying solo, or that you can't do it in another model. That's the beauty about the startup world. There is no one right solution. There's lots of different ones, and they all work together. So it's about bringing people together in a way that works and is effective. And as we say, is about trying to enjoy the experience. So, yep, you do have to have some money, because it is about investing. You don't have to be rich. You don't have to. We're getting a lot more interest now from people who are themselves founders of startups. So people in their 20s and 30s who are interested in getting involved and perhaps putting some money into somebody else's startup while they're still busy building their own. At the same time, we also have the people who are successful business people on their own. Perhaps they're professionals, perhaps they've been running their own business. And that sharing of time and that camaraderie is part of why it's worth doing. We also have the networks. So as Paul mentioned, the angel investor community in Australia really only got started when we started Melbourne Angels. I led an organisation to start angel investing, group angel investing in Australia So that was about 15 years ago. And since then, we've become very well connected with the angel communities internationally. So we do syndicate our deals. That is, we share our deals for both investment and market access with other angel groups around the country, in New Zealand, the United States, Europe, Asia. And those are all the things that it's pretty hard to do on your own. The time it takes to build those relationships, open those doors, understand how it works in a different country, maintain those networks. That's the sort of thing that the scale of having a group of collaborators can really make a difference to.
I agree, Jordan. I mean, a good example, I don't know if anyone from the Flying Kiwi Angels has tuned in. I know there was a bit of a shout out on LinkedIn, but they came to present a deal to us, file invite, very good New Zealand company. And look, I participated just for the fun of being part of a New Zealand kind of Kiwi startup through a New Zealand angel group, and they're a great angel group. And it's you meet people from many parts of the world doing that kind of stuff. So a shout out to the Flying Kiwi Angels if you're tuning into the broadcast today.
So we have another question from Kevin. It's two parts. So I'm going to answer the first part, and then maybe Tracy, I'll give you the second one. The first part is a question of, are you obligated to invest in subsequent rounds of an investment? And the answer is no, absolutely not. In fact, the way that we look at it, the way that we teach people is you should look at every investment as an independent decision. There is no obligation to put more money into a company, and there shouldn't be for any investor, because it all depends on whether it is a good investment at the time. So, Kevin, that's certainly the position that most of us take. Obviously, we have portfolio companies, we would like to support them, but they have to be worthy of that support. And there's a lot more to that about the relationship that you have with the company over time. Keeping your shareholders well informed, you're far more likely to get their support. If you just ignore them and come running to them when you've got a problem, it doesn't sound nearly as good. It's a lot harder to get their support. So there are a lot of factors in deciding, but certainly there is no obligation. Then, Tracy, the second question was, are there alternate exit options if you don't want to invest in those subsequent rounds?
And I'm going to assume that is exit options for your own shares rather than the overarching business. Yeah?
Yes.
Well, look, the answer to that is it depends on what happens with that round. So, for example, it could be a scenario in place where you're an angel investor, you've gone and helped build the organisation. They decide to go for a series, let's say A round or B round, and effectively part of the investment is that they say we want to clean up the cap table. We don't want to have as many people on the cap table or whatever it is, and there could be an exit point there. But angel investment is not about I'm interested now and then I'll just take it off the table at some other time. Our motivation is to stay the course and to help these businesses and to get some true capital return. So we're in the early stage and we tend to be in as long as we need to, but it tends to be a bigger cleanup of the cap table before we would get off. Now, that doesn't mean that you can't put it up. It doesn't mean that someone else may not step in, but it's not something that happens very often.
Yeah, I mean, these companies are always structured, the documents always say it's possible for one shareholder to offer their shares to the other shareholders. But if you're looking at that option, you're usually looking at taking a loss, not making a profit.
The other thing is also, sorry, Jordan, but the other thing is also there's many investments, and in fact, we've had a couple where it went well, then it didn't go well, and then it went well. And so you know, staying the course is really important. And in fact, in one of them that my husband and I invested in, we came in the second round for the Angels. It did not go so well. It was then listed, and then we actually bought in quite heavily later on, and we actually made quite a lot of money out of that organisation. But we stayed the course. We didn't just dump. We actually just stayed the course all the way through. And I think that is the magic of having a broader portfolio, is that you can work to that as an outcome.
Right. So, Paul, what do you say to people when they come along and say, "I don't know enough to contribute to the group. I don't know enough to help people"?
I think, look, I just about everybody I meet can contribute in their own way. It's surprising the breadth of the deals we see through the door. And so, most people have some experience of life. Sometimes people come to us and say, what sort of deals do you specialise in? And we really will invest in just about any deal across just a very wide range of subjects. So in my case, it ranges from travel, which is a little bit of my background. Sports, I never thought I'd invest in sports tech, but I have done. Look, health tech is another big one with Melbourne Angels. I haven't invested in health tech. I don't understand health tech, but there's some great people on the team who really do. And I've got a bit of an appetite to do so, but it's wonderful to go along with fellow angels who do know about that stuff. We've got people who are experts in all sorts of fields, and then you'll just get a deal come along, and then this person will understand the industry brilliantly. So many times, you don't really know how you're going to contribute until you join. But often there's so many things you can do to be part of the group. I wouldn't worry about that.
Yeah.
To that end, Paul, like your experience is not just in terms of the tech and being a founder, it's the fact that you actually really deeply understand government. And often people will want to build something, and its actual major market is government. So it could be that it's the industry sector you've worked in, it's the way that you understand the skill set. So everyone has something to contribute in every case that I've been involved in. And even if that is that they know nothing, so therefore they're not afraid to ask the dumb question that stops you from thinking, hey, that's really smart. I wish I'd asked it that way. So, I think that's the whole point of being an angel and being part of a broader community, is that you'd be surprised what value you can add when you think you can't.
I think that's so true, Tracy. There's two things. The Angel Investment Group is a tremendously diverse community of people with really broad backgrounds. And we've certainly at Melbourne Angels been going through sessions where, while we're in lockdown, it's hard to see each other physically. So individual angels have been going through their little 20-minute potted history of their life. And it's amazing the background of some of our members. I suppose the other thing I'd like to add is that the broad background of the members means that when we invest in a company, of the companies I've invested in, I would have frequent communications from them saying, look, do you know someone who works in this part of government? Or I noticed on LinkedIn you're connected to this person. Can you provide an intro so, because we want to make a sale or we want to put an opportunity in that space. So you find you become part of a very dynamic community, both with the investors but also with your founder companies.
Okay, Kevin's got a follow-on question. Let's see. Have there been circumstances where you disagree with the valuation in subsequent rounds, and how do you achieve consensus? Well, certainly, once you're a shareholder, your influence is generally limited by your shareholding and any special rights that you may have acquired. So it'll be up to the board of the company to determine what they think they want to sell the company at, sell the next round of investment at. And of course, ultimately, it's decided by the actual investors. It's like beauty is in the eye of the beholder, value is in the eye of the investor. So there have been times when we've perhaps disagreed, and more importantly, there have been times when we've been disappointed. And for me personally, one of the things I won't do is invest in companies that are overvalued in their first rounds, because that's likely to lead to all of us having the pain of a down round down the track. and there's very little you can do about that once you're in. But how to achieve consensus? I might ask Tracy to reflect, and actually Paul's done this recently as well. So Paul and Tracy can both reflect on their experience walking through that exact discussion.
So I'll jump in terms of, often people will have a view of value, and that view of value can be tightly held. That doesn't necessarily mean it's right, and it could be that they value it too high or they value it too low. So one of the things that whenever I've been involved is you have to take it back to, well, what are we valuing and why are we valuing it that way? And then how do we talk to our shareholders and any other stakeholders that are required to make sure that we come to some sort of common consensus? And 9 times out of 10, you get there. You might have one laggard or one person who says, look, I just fundamentally believe the business is worth more. If we just hold on for another 6 months, we will be able to sell it for, a factor of 3 times larger or whatever it may be. But in the end, the company has to say, if I'm setting a value for this, I'm setting a value for this for reasons. It could be that I'm capitally constrained. It could be that I think there's some market disruption coming. It could be that I can't grow the company as fast as I would like to because I can't find the right skills or resources. It could be that I've decided that as a board or as a founder that the best way we can actually grow long-term value in the company is to merge it with someone else. And so therefore it could be that it's a script offer rather than cash. And so the valuation is different to what people would think. There's many reasons and many mechanisms why valuation discussions happen. I agree with Jordan. Going in at the first overvaluation is just buying a down round, which is not great. But the way that it's worked for me and the way that it's worked for the businesses and the ones that I've invested in is getting shareholders together and actually going through the data, looking at it, talking about it, working through opinions and just trying to come to common ground. And that inevitably works well. And also remember, it's always the founder and the executive team that are coming and pitching that to the board and then pitching that to the shareholders. And they're the ones that know what's going on in the business. So as long as shareholders can have open access to that and understand what's going on, we tend to come to a common agreement. Sometimes disappointing agreement, but a common one.
If I can add to that, maybe if I focus on not first round but second round, I've just ran a second round raise. There's 2 things that I think it would be good to reflect on. One of those things is risk and the other one is milestones. So later rounds, obviously when you invest the first time, there's a high degree of risk. The subsequent rounds, hopefully there's less risk because you've gone down a bit of a path. And given in the first investment round, you've usually got a set of milestones dictating what you expect the performance of the company to be. So by the time you've come to the second round, you've got a track record, and that track record can really support a higher valuation. Now, we usually try to invest in companies that have the capacity to double in value at every round, because it also, that works for a whole bunch of reasons. Having said that, the round I did recently, there was 12 months gap between raises, and I think the raise was 56% increase in value. And some of the thinking around the rise was also to say, well, we don't want to make it so expensive that we won't get enough Angel Group members to join, but we do want to also acknowledge the risk that the first round investors made. So in the end, it becomes something of an organic discussion with a few pretty logical components to that. So anyway, that's my take on it.
Oh, well, that's great. Well, we're coming up to the end of the session. So thank you all for coming along and for asking your questions. The session was So You Want to Be an Angel Investor. So I hope those of you who are watching are actually interested in being an angel investor. If you are in Melbourne, I'd like you to approach Melbourne Angels and talk to us about what it would take to join the group. If you're in another city, approach your local angel group, and if you're not sure who that is, feel free to ask us and we can tell you. So I wish you all a very pleasant evening.